This is the Retirement Key Podcast with Abe Abish, founder of Abish Financial Services.
A lot of firms out there say they will do tax planning, say they will do Social Security planning and RMD planning, and typically they just do investment management. They want your money.
You've worked hard your whole life to earn and save. Now you need a plan to make that money work hard for you.
Where do you stand today with your retirement accounts, with your insurance, with Social Security, RMDs, taxes, all of it? This is how we need to think. We need to think outside of the box on these matters.
Abe is here to help you unlock the keys to your retirement.
Wanted to ask you about an interesting article in USA Today. They recently published this article titled, How to Manage Your 401k Without Lifting a Finger. According to this article, the whole retirement planning thing that we talk a lot about and the complications of it seems a lot easier than we've been led to believe, Abe. So I've listed here for you the bullet points of this article, and I would love to get your reaction and opinions on some of the points that they made, beginning with the idea where they say, put your money in a low-maintenance target date fund.
Sure. Put your money in a low-maintenance target date fund, that lazy couch potato fund. Sure, we'll do that.
Right. It sounds a little too easy.
Yeah. Just set it and forget it.
Right.
Don't worry about it. Write it out. Hope for the best, and you'll win 10 to 15 years from now.
I'm hearing sarcasm, sir.
No. That's not what we can do. That's not what we should be doing if we're just about to retire or just into retirement, is just hoping for the best, writing it out and waiting 7 to 10 years to see what happens. No way. This market and what's going on right now in this country and across the world and in the markets right now is so unpredictable. We've got to have tactical, actively managed, hands-on, flexible portfolios and retirement plans that can move and be nimble in and out and make changes whenever necessary. So just throwing our monies in a lazy couch potato target date life cycle fund, we don't recommend them.
Right.
And the second point here, Heather, is you won't have to, if you put money in a fund like that, the article said, you won't have to rebalance ever.
Ever being
Really?
the word that made me say, what? Yeah.
Yeah. Another nickname for these funds are called glide path funds, Heather. And what that means is, let's say you chose a 2025 fund, and these are available in the TSP and 401ks and IRAs everywhere.
Okay.
Doesn't matter who the platform or custodian is. And the thinking is that, 2025 is 4 years from now. And if I'm 61 and retiring at 65, maybe I should just throw some or all of my money in this 2025 fund, and they'll do the work for me, because by the time I reach 65 years old, in the year 2025, everything will be all set up, and that's exactly when I retire, and the fund will be perfect for me, right? Well, nothing's perfect, and there are a lot of, actually, we feel improvements that can be made in funds like that.
Really?
And then the last point is just check the portfolio every now and then. Yeah, just nonchalantly check it every now and then.
Not the case.
Man. No, we do not believe you should be writing it out, hoping for the best, and having these lazy, what we call couch potato funds in your portfolio.
Okay.
The reason why, Heather, we call them couch potato funds is because if you looked at what's in a 2025 life cycle or target date fund, you'd probably find that 40, 50, 60, maybe even 70% of that fund is in the bond asset class. And we've talked about interest rates a lot on our show and what we expect bond yields to be, what they are now and what we expect them to be in the near future. And they're not very high. Matter of fact, you could type in, like a huge investment company's bond ETF right now. What you'll find is that the yield It's probably not even 2%. And
really,
definitely not 3%, but we're seeing a lot of 1.3 and 1.5 and 2.2. So if you've got 40, 50, 60, 70% of your money or in a 401k plan that's in a fund like that, it could be really lazy. Not necessarily dead, but pretty lazy.
Well, close to, it sounds like.
Right. So, we just had a lady call into the show, and she is 62. She's going to be retiring here at 66 years old in the next 4 or 5 years. Mm-hmm. And most of her money is in these target date funds. And again, just pointing out the problem, these funds can be expensive. Sometimes you can see expense ratios approaching 1% for the cost of the fund, not including the management and other things. And then also we believe that a lot of these funds are lazy. Why? A lot of times they hold huge bond positions. And sure, bonds are less risky than stocks. And sure, they can help to bring the risk down in a portfolio.
Right.
However, with interest rates being so low, bond yields stink right now, flat out. They stink, right?
Right.
And as a pre-retiree and retiree, we can't really afford to have 40, 50, 60% of our retirement nest egg in an asset class where the advisor might be earning or making more money than you are on your bonds, right? That makes no sense. And then when you factor in inflation, Heather, and taxes, corporate bond rates started off this year with the worst yields in the last 100 years.
Really?
Yeah, so that's why we call these funds lazy couch potato funds. So what is the solution? In this interest rate and market environment, we believe at Abish Financial, we need actively managed portfolios and retirement plans that use technology to better manage risk, standard deviation, and when you combine active tactical management that uses technology, we hire that out. We find the smartest minds in the financial industry who are the ones that have developed this artificial intelligence, the ones who have developed algorithms and this technology because, here at Abish Financial, our team is meeting with people all day long.
Yeah.
We don't have time to sit behind the computers and just watch all the behind the scenes stuff. No. And our clients wouldn't want us to do that either. Instead, we hire that out. So what's a solution? Combining actively managed portfolios with off-market strategies as well.
Okay.
Sometimes we'll position what we call the fixed indexed annuity as the bond portion or alternative in someone's portfolio because if you think about it, if you're only getting pretty much 1% to 3% on your bonds right now, that's not very high yield. And then if you're paying an advisor a fee for the privilege to manage your assets, earning 1 to 3, again, that advisor and that firm may be earning more through their advisor fee than you are on your bonds. So we've got to look at the whole market. We've got to look at all of the tools available that could be in your toolkit, and we have to look both in the market and out. And so sometimes we'll position fixed indexed annuities as the bond portion or alternative of someone's portfolio. And this combination, Heather, has been proven by Nobel Prize winning economists Roger Ibbotson, Robert Shiller, Jeremy Siegel. Some of the smartest financial minds in the world have proven that these combos of both in-market investments and out-of-the-market strategies can be the best combination for a pre-retiree or retiree in this current market environment.
You were pointing out the idea of couch potato investments and lazy money. And I think about the folks that I know that you meet with every day in the office, and these are not lazy couch potato kind of people. I mean,
that's right.
They've worked so hard. They think that they're saving the right way. But the bottom line is a lot of us just have no idea what's really going on in our 401k or other IRA accounts. But this is exactly what Abe and his team can show you. What's actually going on with your money that you have worked so hard for? Is it actually working hard for you, or is it lazy money? And are there ways to improve your positions? That's what Abe and his team can help you figure out, because you deserve more than lazy money sitting in your accounts. You want to find out what investments are going to work best for you in the years ahead. But an interesting article from Kiplinger, Abe, points out that it's not just about our retirement accounts as far as investment options go. When we were young and starting out, we were all told, get life insurance. It's going to help protect your family. But Kiplinger is pointing out that this can also be an effective tool for retirement planning. Abe, can you explain this? How does life insurance help us in retirement?
Yeah, you've got to think outside of the box, Heather.
Okay.
And life insurance, you know what? It can be used for middle Americans. It can be used for the wealthy. 5 or 6 years ago, a Guinness Book of World Records record was broken, and it was the world's largest life insurance policy was purchased by a billionaire on Silicon Valley.
Really?
Why would a billionaire purchase life insurance? She has billions of dollars, right?
Right.
Why do they need life insurance death benefit? Well, they didn't need life insurance, but they chose to purchase it and have it in their plan because of all the tax provisions that are in the IRS tax code. So you've got to think outside of the box, right?
Yep.
And we've got to do things to put a moat around our retirement castle. We've got to do things to layer protections around our investments and retirement plan, not just be investment diversified, but tax diversified. And when it comes to estate planning, we had a couple call in, and they are in Centerville. They're in their mid-60s, and they have a problem that we see almost all the time that we meet with somebody, Heather.
Okay.
That problem is they've saved so much money and they've saved enough that they're going to have an income problem in retirement. And what that income problem is they're not going to be able to spend all of their money, which
sounds like a great problem to have.
It is a fantastic problem. And, immediately when we see that, we'll say, hey, you have an income problem. This means you have so much money. You don't really have an income problem, but that also means you're not going to spend all of this money. Mm-hmm. And it just so happened this couple that's done a fantastic job saving for retirement in Centerville, Virginia, wants to pass on $1 million of the $3 million that they have saved to their kids and grandkids. One of the best ways to pass monies on in one of the most tax efficient ways is through life insurance. And permanent life insurance, if structured properly, passes on typically federally income tax free.
Really?
All of the dollars typically inside life insurance policies, like cash values, are also usually tax-free if structured properly. There are long-term care benefits and things like that included in some of these plans, but they can be a great estate planning tool for those of you listening to the show that actually do want to pass money on to your kids or grandkids or charities in one of the most tax-efficient ways possible. Heather, we need to think outside of the box, and we need to think about ways to layer protections around our retirement plans. And life insurance, yes. Is it sexy? No. Is it like earning 20% on your stocks? No way.
Right.
But man, it can be a great tax-efficient tool to have in your retirement plan.
Thanks for listening to the Retirement Key Podcast with Abe Abish. To learn more about Abish Financial Services, visit retirementkeyradio.com. And join Abe for his radio show, The Retirement Key, Saturdays at 2 p.m. on WMAL.
Financial professionals are not licensed in all 50 states. To find out if Abraham Abish is licensed in your state, please call 571-577-9968. Abish Financial Services is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Abraham Abish, NPM number 770-3575.